Hi, my name is Jeanette Tan, and I work exclusively with owners, office managers, and accounting professionals of boutique wineries. Today I'm going to show you the fundamental 5, which are the 5 parts of the system that must be followed for an effective QuickBooks system for the wine industry. Now, according to Wines and Vines, there are now 9,762 wineries in the U.S., and this is how they break down the different sizes. Notice that they define a small winery as producing between 5,000 cases and 50,000 cases. Now, I don't think that a 5,000 case winery is any way similar to a 50,000 case winery, but let's just roll with that definition for now. So if we take just the limited production and the very small, these total 80% of all the wineries in the U.S., and these are the ones most likely to be using QuickBooks. Many of them are using it incorrectly, which results in bad business decisions and a messy file for the tax preparers. I'm going to show you a 5-step system for setting up QuickBooks correctly that is specifically designed for the wine industry. If you are a CFO, you will be able to easily see metrics like gross profit by channel, and that will improve business decisions. If you are a tax preparer, you will have a cleaner file to work with, which will save you time. And if your clients use this system, they will be more efficient doing the bookkeeping, so you'll get the file faster, and that will improve your ability to serve the clients. A lot of you think that QuickBooks is too hard to use, and that is why the files are messy. Well, it's really not QuickBooks. The real problem is that winery accounting is complicated. So first of all, wineries are a manufacturing operation, and there are 2 phases to this. There's the farming, and then there's the winemaking. Now, the finished wine is sold through many different channels, and each of these channels has different sub-channels. There is no other business that sells their products through so many channels. Now, the DTC channel is typically handled by a POS program, which is another headache. And a winery has all the marketing and overhead activities similar to all businesses. However, payroll has extra complications, and compliance is never ending. Now, the accounting function must also meet the needs of management. Now, because most small wineries are closely held, management has 2 contradictory roles. One is the owner that wants to maximize its profits. The other is the taxpayer that wants to minimize its taxable income. All of these issues have different procedures and processes. So the bookkeeper literally has to wear a different hat when doing them, and that is why the bookkeeping has to be efficient. I would like them to use as many of the built-in features as possible to save them time. Now, orchestrating all of this is QuickBooks. Now, overseeing this 3-ring circus is the winery owner, and they are as far from accounting professionals as possible. They think that because they can take grapes, run them through the press, and after 9 months or so it magically becomes this luscious beverage. They think they can take a bunch of expenses, run them through QuickBooks, and after 9 months it magically becomes a tax return. There are a lot of steps that have to be done right to make good wine. There are also a lot of steps that have to be done right to do winery accounting. So here's the agenda for today. Now, before we get started, there happen to be 5 QuickBooks versions. So first, QuickBooks Pro for PC works fine, but QuickBooks Premier or Accountant gives you a few more features for just a small additional cost. The Premier version gives you the option to install the manufacturing edition. Now, this does not work for wineries because that edition does not allocate overhead. It's only for assembling discrete parts, like for a gift basket. So just install the standard edition. Now, QuickBooks Enterprise has the same interface as regular QuickBooks Pro, Premier, and Accountant, but it is built on a more robust database structure so that mid-sized companies can use it. Now, there was a time when you had to buy at least 5 licenses to run Enterprise, so it made the program too expensive for most small wineries. However, you can now buy just 1 license, so it is a viable option, and it is particularly useful if you want to track inventory in multiple locations, because this feature is only available in Enterprise. It's called Advanced Inventory, and there is an additional fee on top of the basic license. However, most wineries will use the inventory feature in their point of sale program to track the different locations. So keep that in mind before you commit to Enterprise. Now, QuickBooks for Mac will be discontinued as of the 2016 version. The Mac version does not have all the features as in the PC version, and frankly, my clients who use this have very small wineries. The Mac version does not have all the features as the PC version, and frankly, my clients who use this have very small wineries and they can be as well served using QuickBooks Online. So I'm in the process of moving all my clients using QuickBooks for Mac to the online version, which gets us to QuickBooks Online or QBO. Now, despite the rumors and Intuit's marketing, not everyone is moving to QBO, and Intuit will continue to support the PC desktop version because there is a huge customer base who will never move to QBO. For the wine industry, there was a time when I did not recommend QBO because the inventory module was so weak, but they beefed up the inventory, so now I'm okay with a small startup winery using it because it has some features that make it useful for wineries where the owner is doing the bookkeeping. Now, however, QBO is missing some key reports that I use a lot, not to mention that the program runs slowly, so I do not recommend it for a winery that is not in the startup phase. Now, hopefully, as these small wineries grow, QBO will add on more features, but if not, the file can always be brought down to the PC version because that is the version that I recommend for wineries. So on to the fundamental 5. Now, there's more than one way to skin a cat. There's more than one way to do the same accounting function in QuickBooks, and frankly, I've seen some very creative uses of the built-in QuickBooks features. But what happens is that someone tries to use a function in a way that wasn't intended for the QuickBooks workflow, and then they run into a wall. So they call the friendly pro advisor complaining that QuickBooks doesn't work. So the key is you have to use the QuickBooks workflow in the right way to get the reports to work and ultimately to save on your own time. I see a lot of Excel worksheets that are tracking information that could very well be tracked inside QuickBooks. So in my role as a CFO, I provide useful management reports, and an effective chart of accounts is key to that goal. What I see in a typical winery profit and loss statement are the winemaking accounts in the COGS section. There's always a contra account to move these assets to the balance sheet, so the net effect on cost of goods is 0. However, in the middle of the year, when the journal entry for the contra accounts has not been entered, the COGS will be overstated, quite often double the real COGS, and the gross profit will be really small, making the net income completely inaccurate. One of the top complaints I hear from winery owners is that their QuickBooks file must be messed up because the financials don't make any sense. They say, it's showing a loss, but I know I'm making money. And because they don't have confidence in the financials, they stop looking at them altogether. So having the winemaking costs in the cost of goods section makes the financials completely useless, and that is why I do not recommend putting the winemaking costs up here. So on my recommended chart of accounts, I move the other expenses above the line. I keep all the expenses normally found here grouped together. Then I can use the other expenses for the winemaking costs. Now, if you just got squeamish when I suggested moving the other expenses above the line, here's an alternative version. Both of these versions work fine, but the owners tend to prefer the one on the left because it makes reading the income statement easier. And again, we want them to be reading their financials. The important issue is that the accounting function is the same regardless if these are up in the cost of goods or down in the other expense area, because you're still going to use a contra account to reclass these to the balance sheet. But from a management point of view, when you put them down here at the bottom, the winery owner can continue to use the financials all throughout the year, and I can't emphasize enough how critical this is. Now, I've also seen the winemaking costs booked directly to the balance sheet. I prefer having them booked to the other expense section first because first of all, you can run a P&L to budget report, and we want the winemaking department expenses to be tracked the same way other departments are managed. Second, it's much easier to run reports on expense type accounts than on balance sheet accounts. So then the next question I usually hear is, what are the winemaking accounts? And to answer that, here's a brief overview of winery costing. So there's two kinds of wine inventory. Bulk wine, which is work in process, and case goods, which are finished goods. Now, bulk wine has mostly indirect costs, whereas case goods have mostly direct costs. Now, let's review these terms. How accountants use the term costs and how the winery owners use the term are different. A winery owner will call anything they write a check for a cost, and there are four main categories of these kinds of costs. You've got fixed assets, liabilities, There are lots of marketing and overhead expenses, and then everything else is a winemaking cost. Now, winemaking costs are either direct or indirect. A direct cost is directly associated with a bulk lot or finished SKU. Everything else is indirect. For you tax preparers, the IRS uses the terms direct and indirect in a different way, but that's another conversation and another seminar. Now, things like gases, winemaker salary, and utilities cannot be directly associated with this specific bulk lot, so these and many more are indirect costs. Now, we group these costs into cost pools, and typically there are 4 cost pools. We then need to allocate the cost pools to the different bulk lots. So the second complication is that these costs accumulate over time. So a Cabernet that is barrel aged for 12 months will be in the cellar for 3 calendar years. The allocation formula is based on time and quantity. So because of all this math, the allocation has to be done in Excel. So to calculate the bulk wine, we accumulate the costs in QuickBooks, then we use Excel to allocate the cost pools to each bulk lot. In QuickBooks, the balance sheet will have only one value for the bulk wine, and the Excel book will then be your schedule of the bulk lots. The beginning and ending totals of all the bulk wine will match the values showing on the balance sheet in QuickBooks. I've seen many attempts to track the costs of the bulk lots in QuickBooks, but the process is cumbersome and it is inaccurate because it cannot account for the accumulation of the indirect costs. Plus, try to factor in blending, let alone topping, and you end up with just a mess. So back to the case goods. The costs are for the bottling, and these are mostly direct costs. Now, I want to warn you that handling those bills is one of the most time-consuming tasks for the bookkeeper. On my website, I have a mini course that shows the 2 methods to handle the bottling bills. Now, after the wine is bottled, the costs stop accumulating. Since the cost does not change, we use the built-in inventory process in QuickBooks, and that works really nicely. Now, since we are talking about costing, I am obligated to make my usual plea. In order to calculate the costs accurately, the seller team must provide good reports. QuickBooks cannot create these details out of thin air. All right. Okay, that was just a digression. So here's some recommendations for the sub-accounts for the seller cost pool. The actual number of sub-accounts will depend on the winery's winemaking process and workflow. For example, if a winery uses a custom crush facility, there will be just a few of these seller expenses. These are the common sub-accounts for the bottling costs. Now, if the winery does not use a custom crush service, you'll need a cost pool for the crush costs. Here's some common direct winemaking costs. Now, the barrel depreciation is actually the barrel cost pool, and then you need the contra accounts to move these to the inventory asset. And I go into much more detail with these accounts in my QuickBooks class and also in the costing class. Now, on the asset side, these are the 4 main inventory accounts. Now, these sub-accounts will help you see the movement of the costs through the balance sheet. These sub-accounts will save you a lot of time, especially when it comes to truing up the costing book with the bulk wine on the balance sheet. And yes, the costing book is supposed to match the balance sheet. Now, these are the accounts used to offset the winemaking contra accounts. And this is the offset account to the COGS accounts. These sub-accounts are then reset at the beginning of the fiscal year. Now, if you see this in a QuickBooks file where there are sub-accounts for each bulk lot, this procedure does not work because it's inefficient and it's not accurate because there's no allocation of the winemaking overhead costs. These bulk lots belong on the Excel costing book. So for an effective chart of accounts, you're going to make the winemaking costs and other expense types so that the winery owner can use the income statement throughout the year. And you're going to group the winemaking costs into cost pools that are then used on an Excel costing book to allocate the bulk lots. Next step. Once the wine is bottled, the case goods are tracked using the standard QuickBooks workflow. When this is set up correctly, QuickBooks will calculate COGS in real time, and QuickBooks will also create an accurate inventory report. Now, there are 2 steps to this process. The first step is creating the item, and the second step is recording the quantity and the cost of the new SKU after a bottle run. So here's an example of a correctly set up inventory item. There's 3 parts of the entry When you create an item, okay, there's three parts to this entry: a COGS account, an income account, and a current asset account. When you create the item for the first time, these blank cells will stare at you, begging for you to enter something. You must resist the temptation to fill in these blanks. The information ends up in a black hole and is ugly. You know that opening balance equity account? That one. All you're doing in this step is creating the item. I'll show you later how to enter the quantity, but first let's look at a few reports. When the inventory items are set up correctly, you will get an inventory report that looks like this. This is a standard built-in report. It has the quantity on hand, the cost, and the total value. After I clean up a file and show this report to the owners, they are amazed this report even is available. Now, in a typical winery, I often see this setup where there are multiple income accounts for the wine sales, each income account associated with a different sales channel. Now, as you noticed, when you set up the inventory item, you can only have one income account. So people try a workaround where they track the sales to different sales channels. However, having these multiple income accounts is not necessary because there's a better way to handle this, and I'm going to show you that in a little bit. Now, this is another thing that I often see. So don't do this either. In this case, there's a sub-account for each SKU. You don't need an income account for each wine. There's a standard report in QuickBooks that shows the sales by item. So you don't need individual income accounts to see the revenue for each SKU. And again, this is a standard report in QuickBooks. Now, this is the second part of an incorrect setup that I see in a typical winery. Each SKU will have a family of items with one item for each sales channel. In this case, the 10 Pinot has 3 different items because each item points to a different income account. The concept is to transfer cases within a SKU family so that the grand total of the SKU family equals the actual total on hand. The problem is that the bookkeepers simply do not have the time to maintain this. So the inventory often goes negative, and QuickBooks doesn't like to go negative. This can cause data corruption. A typical problem I also see is that there's no cost associated with the items. So the asset value is not accurate either. So I do not recommend this setup where you have multiple items for the same SKU, and I don't recommend not entering the cost. Now here's the second step of setting up the inventory correctly, which is to record the cost and the quantity after a bottle run. So if you had a t-shirt shop, you would create the item first, and when the shirts arrived, you would either enter a bill or write a check and list the products on the item tab. Now remember, wineries are manufacturing entities because we're converting raw material into finished goods. You already own this asset, so we need to do something similar to a bill, but one that does not increase the inventory asset. Now, you could do a journal entry to reclass the assets from bulk wine to case goods, but in QuickBooks, you can't use items on a journal entry. So some brilliant pro advisors created this great workaround. We'll make a bank account called journal entry, and we create $0 checks. These $0 checks are going to do the same accounting function as a journal entry. Just as if we were buying wine from an outside vendor, you create a check and list the products on the item tab together with the quantity and the cost. Now, we need to create an offsetting account to get this check to 0. So on the expenses tab, on the first row, enter the asset account that you identified on the item setup, in this case, release to cost of goods. And the amount that you enter is what you see on the item tab as a negative number. This creates a $0 check. However, we also need to record the value of the bulk wine used in the bottle run. So these next 2 rows are going to transfer the value of the bulk wine used in the bottle run out of bulk wine and into case goods. So we still have a $0 check. Now, for those of you who don't trust QuickBooks, here's the GL entry for this transaction. This row is for the first row on the expenses tab. Notice that it's a credit entry because a negative amount on a check or a bill shows up as a credit value. This group is from the items tab, and the last pair are the other rows on the expenses tab. Now, as I mentioned, QuickBooks will calculate COGS in real time, but inventory items are special because they behave differently depending on the kind of transaction they are used on. So this is the GL, well, this is the GL for a check or a bill, and it only hits two accounts, one debit and one credit. When used on an invoice or any sales form, it becomes a two-way transaction with two pairs of accounts. The first pair is AR, or cash, if this was sales receipt, and an income account, in this case, wine sales. And the second pair is COGS, and it will relieve the inventory asset account. So the typical accountant workflow for a winery calculates COGS on a spreadsheet, and then the accountant will create a journal entry to record the COGS in QuickBooks. This process is not necessary since QuickBooks calculates COGS in real time, so there's no need to do this work paper. So when QuickBooks is set up, when you set up inventory correctly, every SKU will have a cost, so that when a sale is made, the cost is automatically deducted from inventory and charged the cost of goods. So you'll know immediately after a sale is recorded what the cost of goods is for that sale. So one of the unique things about the wine industry is that the sales are made in many different channels. The sale price in these channels is often different, so we want to be able to review the gross profit for each sales channel. Therefore, a key metric is tracking the gross profit by channel. So we need a system to track the sales by channel. We saw a couple of attempts to capture the revenue for different sales channels. Unfortunately, these were not effective procedures because they were too complicated to maintain. The other problem is that these methods only track the revenue, not the COGS for each channel. An effective method to track the sales channel will allow you to calculate the gross profit for each channel. So in QuickBooks, the best way to track sales by channel is to use classes, because you automatically get to see the cost of goods by class as well. Now this is a built-in gross profit by channel report. In this example, the revenue for the FOB or distribution class is double the retail class, but the wine cost of goods is less than a quarter, so the gross profit for the wine sales is significantly higher for the retail class. What we often see is a high top-line revenue for the distribution channel, but a very small gross profit. Often the owners are horrified when we discover that they've been losing money in the distribution channel, even though their top-line revenue is high. This shows that simply tracking top-line revenue can be a fatal mistake. When I show them their true gross profit in the distribution channel versus the DTC channel, they can easily see where to put their effort. And giving management useful and meaningful reports should be a key goal. Now, many people try to filter the P&L by customer type, and this works to a point, but you run into a problem when tracking your DTC customers. When a wine club member comes to the tasting room or to an event, where do you classify the sale? So the bigger problem is that you cannot get all of the standard reports by customer type. Another key report that you can only get with classes is the actual to budget report. So this is a gross profit to budget report for the distribution class. This shows whether you are on track for revenue and gross profit for both the previous month and for year to date. Now the trick for small wineries is to only use classes on the sales transactions and no class for the expenses. When you run a P&L by class, the expenses will show up as unclassified. For many small wineries, their expenses are primarily for general and overhead expenses. It takes extra time to figure out where to class an expense, and for the small wineries, that exercise would not generate any useful information. Now, for a larger, more complex winery that has professionals in the accounting department and distinct sales channels with distinct staff, for each sales channel, instead of the owner running around doing the selling, then they should go ahead and class all the expenses as well. Now, generally, I run a gross profit report for the sales channels. But to see the entire operation, I'll run a consolidated P&L. So to track your sales by channel, go to Preferences and turn on Classes. Select some meaningful classes where there is a clear business distinction that identifies each class. And expect to have a different set of classes for each winery that you work with, because every winery has a slightly different business model. You can even go back and add classes to previous sales transactions. The information you will learn will be worth the effort, I promise. Now, because the DTC channel is so critical to the small wineries, most operate a tasting room where they use a point of sale program. Some small or appointment only tasting rooms can enter these sales directly into QuickBooks. However, most have at least either a shopping cart on a website or they use a winery specific POS program to run the wine club. All of these programs are external to QuickBooks, and it is well known that it is difficult to get the information into QuickBooks. But that is because the point of sale programs have some weird challenges. Now, the solution that I see in the typical winery is a deposit slip that looks like this, that records the credit card deposits to the wine sales account. Needless to say, this provides absolutely no information for management because this is the dollar amount of the credit card deposit that was made in the bank, and it includes sales tax, shipping, merchandise sales, and in some cases, it also includes the deduct for the merchant fees. So you have absolutely no idea what's behind this number. And what's even worse, many bookkeepers simply copy the information from the bank statement, so there's no control that the correct amount of money that should go into the bank account ends up in your bank account. So there are no controls. Needless to say, this procedure is just wrong from so many angles, yet it is so pervasive in the wine industry that it's considered to be a standard procedure. Now, when I say integrate, this step is likely to be a manual integration. When I first started working in the wine industry, like many of you, I focused on finding a POS program with an automatic integration with QuickBooks. But what I discovered after working with over a dozen of the most popular programs is that the best programs don't automatically integrate with QuickBooks. What the best programs have are excellent reports that you use to then manually bring the information into QuickBooks. There are two ways of getting this information into QuickBooks. The push-in and the summary method. My preference is the summary method. And for the small wineries, this will be at the end of the month, but for a larger winery, this might be at the end of each day. You'll run a report that shows your sales by SKU with the quantity for each sales channel. Then you either manually key in the information, or your friendly pro advisor can create a report, a process to import it. This gets the sales detail into QuickBooks, but you still need to record the payments, both the cash and the credit card payments. For that, you enter what I call the dailies. You need to find a report in the POS program comparable to a Z report, which summarizes the payments tendered for the day. Now, if your program cannot easily make both of those reports, a sales summary by channel and a Z report, you will have to use the second method, which is the push-in method. Most programs will generate a data dump, and you use a utility program like Bay State Transaction Pro Importer, which pushes the sales into QuickBooks. There is one sales receipt in QuickBooks for each transaction in the POS program. There is a second step where you have to batch the payments. After you do the push-in, the payments go into the undeposited funds window, and you need to batch the payments onto a deposit slip so that the deposit will match the deposit into the bank. The cash payments should be deposited into petty cash. This process is fine for a winery up to about 5,000 or 6,000 cases. It starts to be a little cumbersome beyond that. There are a few POS programs that do not provide any of the reports I've mentioned or even the data dump, so you cannot do either the summary or the push-in. So you're kind of stuck. So here's a snapshot of the POS programs that have good reports so you can do the summary method. Now, these programs don't have one of the two reports needed for the summary, so you have to do the push-in method. These programs are typically well priced for the small wineries, although some are better than others. Now notice that Active Club does the push-in automatically. And these programs have some kind of challenge that makes the manual integration almost impossible unless you're working with a talented pro advisor. You will have to decide the benefit of continuing to use these programs versus the benefit of you having useful financial reports. The best POS programs will generate the reports needed for the summary method with just a few mouse clicks. Also consider the bookkeeping staff and their ability to handle things like pivot tables. So factor in the total cost of ownership when you evaluate a program. An inexpensive program might not be that inexpensive after you add the time the staff needs to fuss with the reports or the interface. The POS programs are the single biggest hindrance to the small wineries being able to generate useful financial information. They don't have to, because there are good programs at a reasonable cost for the wine industry. Just be careful around those salespeople because they are very good at showing off all their shiny bells and whistles while also saying, oh, I don't know how the financial piece works, but let me show you this awesome feature. The bottom line is that there is no way of managing the business and knowing where you should put your energy without this information. QBO is beginning to have many programs that will integrate it with it, and this is a boon to the startup and the micro wineries. Keep in touch for more information as I start to test them. Now, we are in the wine industry, so samples and shrinkage are a fact of life. Imagine if we were selling mattresses. You would never give out a sample, and shrinkage would not be a problem because no one hides a mattress under their jacket at the end of the day. So if you've done everything right up to this point but have not entered your samples or shrinkage into QuickBooks, the fact of the inventory report not matching the physical count is not a QuickBooks problem. So the last step in the system is to record samples, pours, and shrinkage. Now, this is what the transaction looks like. You need to create a class just for the samples, in this case depletions. The second key is to record the quantity with $0 for the rate so that nothing is reported for the sales value. This example is for a sale of 3 cases to a distributor that also includes a case of samples. So you use the FOB class for the sale when the depletion class and the depletion class for the samples. If you use the FOB class for all of the wine that was delivered but not necessarily purchased, you will throw off the average case sale metric, and that is an important metric for the management to monitor. A critical step that is often ignored in the micro wineries is doing a physical count of the case goods and then reconciling QuickBooks to the physical count. I recommend that a physical count be taken at least every quarter because no one in the wine industry is able to count correctly. By having 4 counts a year, you have a better chance of an error getting corrected on the next count. Plus, it gives the winery crew practice counting. Now keep in mind that QuickBooks Pro and Premier, there is only one inventory location, so you have to have a method of reconciling the inventory showing in QuickBooks with the total cases in each of the warehouses. You have to use an Excel sheet to summarize the quantities at each location. So first you export the inventory report to get the SKU names and the quantities. Then create a column for each of the locations. And frankly, this whole procedure is way easier than using the multiple inventory location in Enterprise. Now to make this work, because to make that work, you almost have to have a full-time staff accountant entering all the transfers. Now, an important detail when doing this reconciliation is that QuickBooks reduces inventory at the time of a sale. So after every wine club, you often have some wine that was paid for but was not picked up. So you have to have a way of tabulating the wine that has not been picked up but has been paid for.